Ever wonder what actually happens after a multifamily property goes under contract? From the first offer to the final investor payout, there's a clear timeline every deal follows, and knowing it can help you invest with confidence. In this video, we're going to show you each stage step by step. So whether you're brand new or just curious about how the process works behind the scenes, you'll know exactly what to expect from start to finish. When an operator first starts looking for investment opportunities, they're likely to first tap the broker community in that particular market. And it's really those broker relationships that give us the opportunities where we oftentimes have that first right of refusal. We're also in a position oftentimes to find off-market deals as well. So after we've submitted the letter of intent, that's really when the due diligence process starts. And due diligence can typically take anywhere from a week to 2 weeks for us to complete. During that process, we're not only doing a deep dive on the financials, but we're also walking all of the units on site in order to find those potential skeletons in the closet, so to speak. After we've signed the PSA or the purchase agreement for the particular property, of course, which happens after due diligence has been completed, then our next job is to really source our equity providers as well as secure the bank financing. We like to leverage lower leverage loans in our investments. So most properties we're looking to raise from our passive investors about 35% of the total equity needed in order to close on the transaction. Typically in the first 90 days, we're looking to transition the legacy management team over to the Rise48 in-house property management team. In addition to that, one of the very first things that we do is we repaint the property with our 3-tone exterior paint. We're going to start renovating units when units become available or they're empty. And there are times during the course of the business plan where it makes sense for us to accelerate those renovations. And there's also times during the course of the investment hold period where it makes sense for us to pump the brakes. Really, the main goal here is we want to maximize investor returns. So as a direct result of that, we focus in on yield on cost. And yield on cost is really a very important KPI metric that we look at to ensure that as we renovate units, are we able to achieve the pro forma rent growth increases that we projected to hit and achieve. At Rise48, we provide monthly reporting updates that provide our investors with a glimpse into how the renovations are going. It's important for us to remain incredibly transparent with our investor community that's invested in that specific project with us. When can investors start to expect to receive their first distributions on their investment? We buy properties that are cash flowing immediately. We typically expect that first month of distributions to be paid about 60 to 90 days post-acquisition. It takes a little bit of time for us to repurpose the property and the asset. So it's also important for investors to understand that distributions will change over time. For example, as we force NOI growth and there's more cash flow available at the property level, that has a positive impact on the amount of distributions that investors should expect to receive from their investment. If we're in a market that has a glut of new supply that hit that market, for example, it may be that we have to provide concessions to have a higher amount of occupancy at that property level. Of course, concessions and things like delinquencies and accounts receivables, they can impact cash flow. So as a direct result of that, there may be a point during the investment hold period where distributions may either stay flat or potentially even decline over the course of that investment hold period. So it's always important for investors to begin with the end in mind. So what is the likely outcome of an investment, or what are some decisions that the main operator needs to make after they've executed their business plan? There may be a sale. It may be time to sell the property. Oftentimes buyers include private equity companies, maybe other syndicators that are in the space today. It might include companies like life insurance companies or hedge funds, right? So we're in a position after we've effectuated our business plan in order to be able to be in a position to sell. But it also may not be an opportunistic time for us to sell depending upon where we're at in the market cycle. It may make more sense instead to do what's called a cash out refinance, where we're able to return a portion or up to all of investors' original capital back to them, allowing them to remain in the deal at the same equity level that they originally partnered with us, but effectively they've now reduced their exposure because they received a portion of their original investment back, which also allows them to then redeploy that return of capital into another investment. So when it's time to sell a property, investors have a decision to make. The decision is really, do I take my return of capital plus my profit and redeploy that into another investment, or maybe choose to build that backyard pool, for example? Another strategy that many of our investors opt for is the 1031 exchange option, which allows that investor to effectively kick the tax consequence down the road even further by keeping their original investment and their profit in real estate without having to incur any capital gains tax consequences on that profit. Thanks so much for joining us today. Really appreciate you being here. If you'd like to learn more about partnering with us at Rise48, please reach out at Rise48Equity.com.